Hello everyone, here I am going to discuss the accounting cycle and make sure that I use these transactions to explain how this accounting cycle gets to the 10 step. There are 10 steps of this accounting cycle. We have the first we have to analyze and record transactions in the general journal. These are the transactions that we are going to analyze and record to the general journal, and then we post to the ledgers. The ledgers are accounts that are just open based on these transactions. Then we prepare unadjusted trial balance. Then we are going to assemble and analyze adjustments, and I'm going to show you an optional end of year spreadsheet and the and journalize and post adjusting entries to the ledgers. And I'm going to prepare the adjusted trial balance. I'm going to show you that to you, and the financial statements, and then prepare the closing entries, journalize the closing entries, and then the post closing trial balance. So please pay attention to these transactions and see how we analyze them as we go. Okay? Okay. We just get to the journal entries. Okay, this is step one. Um, After the journal entries, you will not see this anymore because I will show this in a enlarged PowerPoint slides. Okay, so pay attention to the journal entries. So this is a business person by the name of Alfred, who I said Alfred started a cleaning business, and at the end of the year he has the following transactions to report. So Alfred reported 10,000 cash in the business. This is his startup cash. This is the cash that he started with the business, which is and in accounting, when you start with a business, that business is your capital. And how was it started? With cash. Sometimes you can start your business with something else. Sometimes it could be machinery or any assets. You could start a business with that. Okay. So what do we do here? We determine the two accounts that are involved. And once you get the two accounts that are involved, so you have to know which account that receives and which account that gives. And once you get those, then you start going for each of these transactions. So first we say Alfred invested 10,000 cash into the business. So we say cash, letter A, cash is 10,000 debits, and Alfred capital 10,000 credits. Okay. Then Alfred bought supplies for cash. So you determine the two accounts that are involved here. Here we have supplies account and cash account. So you determine which account that receives and which account that gives. As I say here, the account that receives you debits, the account that gives you credits for each of these transactions. And let me see, for your entire accounting career, just go with these tools. When an account is receiving you debits, when an account is giving you credit, just go with these tools. This will help you very, very greatly. So if we bought supplies for cash, that means cash is given, which is credit, and supplies received. So we have to debit supplies by 300 and credit cash. We go to C, purchase equipment for cash 1,000. You determine the two accounts that are involved, equipment and cash. So equipment is receiving debits, cash is given credits. Perform services for customer on credit. This you think about accounts receivable. When you perform a service for a customer, but the customer hasn't paid you yet. So you think about the account that tracks all the money that you are going to get in a later period. That's your accounts receivable. So what do you do? So since the money hasn't been received, and that's your revenues, because this is money that you already hope that you will get, is gonna be your service revenues. So you determine which account that is receiving, and the account is accounts receivable is receiving it, and which account gives revenues, service revenues. Both accounts are going up. So you debit accounts receivable and credit service revenues. You go to E. E says purchase additional supplies on account. You purchase supplies, but you haven't paid yet. Okay? That means you purchase them on credits. So supply is receiving. But this is you creating a liability for yourself, which is called liability is called accounts payable. So you record the amounts. So you go to F. F says customer paid for service performed on D. So let's go to D. What happened on D? You perform a service, but the customer hasn't paid you yet. And F is saying now the customer pay you $500. So you record your cash because cash is receiving 500. And since this account is there to track what the customer owe you, and now since it's reduced by 500, you credit this account by 500, which is account receivable. You go to your next one, G. It's a receive cash for performing service. You perform a service for a customer, and this time the customer pay you cash. So since you're receiving cash, you debit cash and you credit service revenue. Please note that anytime you see perform service, reflect yourself to revenues. Please, whether it's commission fees or revenue fees or service revenues, please pay attention to that. Paid delivery expenses. Anytime you see the word paid, that means just think about cash. Okay? So pay delivery expenses 400. So which two accounts that are receiving? Delivery expenses is receiving here and cash is given. So delivery expenses. Oh, I'm on H. Oh damn. Okay, so let me go to H. Delivery expenses is receiving and cash is given. I says what? I says Alfred withdrew 700 cash for personal use. He is paying himself. He withdrew this money. So cash is given to withdrawals. So withdrawings account is 700 and cash is 700. J paid 600 on the liability for supplies. Pay attention to these two transactions. When they say supply, it doesn't necessarily mean like you have to use the supplies account again. There was a liability that was created here, and now there is a payment made by you, the business person. So you, the accountant, have to take note about this. Okay, the liability that was created, which is accounts receivable, is now going to reduce by $600 with cash. So cash is given. So cash is given to 600 to where? To account payable. So you debit account payable, which is receiving, and cash is given. So if cash give you credit cash. Purchase 800 of supplies on account. You purchase 800 of so this is another account payable. So you purchase 800 of supplies on you purchase supplies, but you haven't paid the person yet. So these are purchased on credits. So what do you do here? What do you do here? Since you are using account receivable, account payable for supplies, you debit supplies and credit accounts payable. Paid rent for the month 300. You paid rent. Rent is receiving here. Cash is given. So if rent is receiving, debit rent, and credit cash. Paid insurance for 3 years, 1,200. You pay insurance. So this is a prepaid insurance. This is a payment that you made in advance. Okay, these are called prepayments. So what do you do with prepayments? Since this money is already paid for insurance for 3 years, so you debit the entire 3 years, which is 1,200, and cash that. Okay, so now we go to our second step, which is posting to the general ledger. This is posting to the general ledger. Okay, so let me make this for you like this so that we see everything here. So this is just a collection of all the transactions that we journalized. Okay, so this is telling me that this is was started business. If you go through my first slides, you will see the effects of this. Okay, for cash accounts, debit is the normal balance. All assets, debit is the normal balance. So for this account, just take a good look at it. For 8 transactions, you see the account increase in the first column, by 10,000 and 10,000. Anything that appears here is a deduction. Anything that appears here is an addition. So this equals to this, minus this is equals to this, minus this is this, plus this is this, plus this is this, minus this is this, minus this is this. So at the end of the month, or at the end of the year, we have cash total of 6,800. This is our accounts receivable. Okay, the first we performed service, but the customer didn't pay us, so we record it here. When the customer paid us $500, so the customer owes us $1,000. This is simply what it says. This is supplies account. We purchase supplies with these amounts, and these amounts, and these amounts, and these amounts. This adjustment, we are coming to it later. This has to do with the fourth step or fifth step. Continuation. This is our equipment account. We purchase the equipment for 1,000. So this is amount. Prepaid insurance. We prepaid insurance for 1,200 for 3 years. This is it. This was the adjustment. Accumulated depreciation. So let me explain to you what accumulated depreciation is in the most simplest terms. Let's say you have your equipment. Let me say you bought your car, and this car is what you are using in the business. Or let me use the equipment account. You have this equipment, you just bought it, and you start using it in the business. Don't think that if you sell this equipment tomorrow, you will get the same amount. No, because once you start using it, the value of that depreciates, and as the value depreciates each year, that depreciation is recorded to this account called accumulated depreciation, and the following year, as the value depreciates again, is added to this. Okay, so that's simply what accumulated depreciation is. So you keep accumulating until the lifetime of that asset is completely used. So the continuation to step 2, accounts payable. This is our liability. Okay, we created a liability and we paid 600. We created a liability of 900. We paid 600, leaving us with this, and 800 again on supplies. On account payable. Then we have a liability of 1,100. Then we come to our capital account. Okay, capital account. We started the business with $10,000. This is $10,000. Then there was a withdrawal of $700. This is $700. Why is this on the credit side? Because these are the normal balances of these accounts. Okay, if you go to my first video that I posted, you will see how I arranged it there with colors. Then you come to your service revenues accounts. This is your revenues, the amount that you receive for the work that you perform. First, you receive this, and second, you receive this, so you total 2,300. Then this is the accounts. This is the income summary accounts that I will explain to you in the further slides. I will have to come back to here. Okay. Continuation. These are our expenses. Delivery expenses for the month is 400. Rent expense is 300. Insurance expenses account. This is an adjustment right here. There was an adjustment that we did, but we'll come back to this when we do our adjustments. This is an adjustment too. Adjustment also for depreciation. Depreciation is simply, in simple terms, is the fall in value of an asset. This is just for beginners. Okay, when we get into the real accounting, I will define what depreciation is. But for now, just keep in mind that is when your assets reduces in value. The cost that is reduced in value is allocated to this account that is called depreciation. Okay, so I just made two new words that you people have to remember when you are dealing with this kind of accounting, especially going to the next steps. Okay, I have developed this word, which is allure. Allure will help you list items in the trial balance. So I said list all assets first, liabilities second, owner's equity, revenues, and expenses. Then you come to the other word. This will help you in journalizing your closing entries, which are your temporal accounts. You close revenues first to income summary. You close expenses to income summary. You close, this is normally your net income, but if I just say income summary, you're gonna be doubts where you are getting this figure. So I have to use net income so that you actually understand that this is actually the net income, because when you subtract this figure from here, what you get is net income, which we call the income summary when you close in these books. So I call it net income, but it's close, but it's an income summary that is actually close to capital. So drawings or dividends if you are dealing with a company. Okay, drawings. So I call this word rend. Okay, and this word is allure. Let's go. So here is our step 3 on adjusted trial balance. This is a trial balance that after journalizing everything before doing the adjustments, the list of all the accounts that we had is brought up to this trial balance, to this list. Okay, and it giving us this total. Okay, let's go. Now we are in step 4. We assemble and analyze adjustments. This is just like doing a physical inventory of all the stuff, of all the assets, the liabilities, the expenses, the revenues that you had in the period. Okay, so how do you do it? You think about your prepaid expenses, your on-hand revenues, your accrued revenues, accrued expenses, depreciation expenses. Okay, so I will have to make a topic based on this, but because of the time on the video, because I have a less space on my camera, I would just want to try to explain it as quickly as I can. So this is the inventory that you perform for the year, because this is an example, just 3 examples of what I'm gonna do with this. We say insurance used or expired for the period is 400. Whenever they say insurance used or expired, this is expensed. Okay, so know about that. Anytime you see this word used or expired, just relate that to expensed. Okay, supplies counted and on hand is 1,500. This is the supplies that you have right now. Okay, and depreciation of equipment 200. So this is our step 4. Let's see how we journalize and did those adjustments. Okay, step 5 is an optional end of year spreadsheet. Okay, the optional end of year spread shows the flow of accounting data. I said dates. Accounting data between unadjusted and adjusted trial balance. He also do this, the effect of plan adjustments on all the financial statements, and he shows the 10 column of all accounts. This is the 10 column: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is your 10 column from unadjusted to the balance sheets, and these are your 10 column. This is an example of the worksheet that is optional, but it's really necessary to do this. Very, very necessary. Okay, so now we are journalizing and posting adjusted data. This data that we had in step 4 is this. At the end of the year, after you did your inventory of your expenses, or your prepayments, or your accrued expenses or accrued revenues, these are your adjustment entry, your journal adjustment entries. And this journal adjustment entry is then posted back to the ledger's accounts. Okay, I will show you how one of them is posted to the ledger's account. So we said insurance expired 400, because the insurance was for 1,200 for 3 years. So for the year, we get 400 insurance used. So our prepaid insurance is now credited, which means we used it for the year. Supply expenses 500, and supplies 500. So this means our supplies, we said supply has a balance of 1,500. That means the entire supplies that we purchased was 2,000, but on hand supplies is 500. So the supplies that we used is this $500. Okay, depreciation equipment, our depreciation is 200. That means this equipment is only going to last for 5 years, because the equipment is, the cost of the book value of the equipment is $1,000. So if this year this equipment depreciates by $200, that means for 5 years it's gonna depreciate entirely. Okay, so let me take you back to one of the adjustments so that we see how this adjustment was done. Okay, so let's see here. This is the adjustment. This happened at the end of the year, December 31st. Anywhere you see December 31st is an adjustment. Okay, these are our adjustments. Okay, income summary, prepaid insurance. These are our adjustments. This is our adjustments. Okay, and what else? Is there any more adjustments? Get supplies. Supplies, we had 2,000 supplies, but we use 500. So this is our on hand supplies. Okay, okay, this is just step 7, the adjusted trial balance. This is the adjusted trial balance. Here I have just included these two for you to understand how I came up to this figure, but the essence of preparing this is actually for this. But these are the adjustments at the end of the year for you to see how this play. So it came up to this. So look at this. Cash is still the same. Our accounts receivable is still the same. Supplies was 2,000 and 500 was used, and on hand is this now. Equipment was 1,000, and still 1,000. But there is a depreciation, accumulated depreciation of this, which is on the credits. If prepaid insurance was 1,200 and we use this, so we have 800. So just look at these figures, and this is our totals down here. So now look at our adjusted trial balance. This is our adjusted trial balance, which is the same figure as what you see here, 13,600. So it's 13,600 here. This is our adjusted trial balance. Okay, let's keep going. And now we prepare our statements. I have to explain to you how I came up with the word allure. The word allure, I haven't used it here. Allure, you list all your assets first, you list all your liabilities second, third, owner's equity or owner's capital, fourth, revenues, and fifth, expenses. This is your allure in that order. That's the order of operation that you have to use. Now we go into our financial statement, which is our step 8. Step 8 is our financial statement. So what statement? The income statement. The income statement consists of revenues minus expenses, which sometimes gives you net income or net loss. Okay, the setting has to look like this because this happened in a period of time. So you say revenues is this and expenses is this. So revenues minus expenses gives you a net income of 500. So this business has a net income of 500. Let's go to the next statements. These are statements of owner's equity. Some in companies we call it statement of retained earnings. Okay, the setting has to look like this. Alfred beginning capital, or you could say Alfred capital January 1st 2015 is 10,000. Add net income 500 less drawings, which is 700. So there is a decrease in capital of 200, which resulted in a low income versus a very higher drawing. So it leaves us with this. So at the end of the year, our ending capital is 9,800. Let's go to the balance sheet. The balance sheet, which is asset equals to liabilities plus owner's equity. The setting has to look like this. Again, don't forget, use your thing. So here, you list the assets equals to liabilities plus owner's equity. So these are your assets. This is your total assets. Look at what happened here. The equipment was 1,000, and now it depreciated by 200. So the value by the end of the year is 800. So if you prepare for 2016, this is gonna be 600 because this is gonna go up. Okay, so you have to pay attention to that. Okay, prepaid insurance. We had prepaid insurance of 1,200, but now we just have 800, and our total assets end up to 10,900. Our liabilities, we only have one liability, which is accounts payable, 1,100, and we already have our capital over here in the last one, which is 9,800 in our statement of owner's equity, which you just transfer to Alfred capital, 9,800. So asset equals to liability plus owner's equity. So this will give you the same figure. Now we are going to journalize our closing entries. So our closing entries go with the word rend. You close your revenue first, close your expenses, close your net income, and close your drawings. So remember, the closing, the normal entries of revenue is a credit entry. When you're closing it, is the revise. Debit, for expenses was a debit entry, and when you close it, it's a revised. same thing with this account. Okay, the same thing with this account. Do the same thing. So this is your asset, this is your revenues, this is your expenses total. When you add all of these, you get this figure. So you subtract this from this, you get 500 that I said. So for you not to be in doubt, is actually a net income, but we say this is an income summary account. So do not forget, this is an income summary account. But for you to understand, know that this is a net income amount. Okay, but is the wording is changed to income summary account. Okay, then you bring the drawings figure, which is 700, and close it to capital, and you do your post closing trial balance, which is just, you're just gonna close your permanent accounts and getting them ready for the following year. And this is simple. If you understand this just as how I explained, then you will be good with your accounting background. Our next topic is coming. Stay tuned. Thank you.